Hi, welcome back to the Business Career College video series. In this video, we're going to cover part 2 now of our Building a Multi-Year Cash Flow worksheet. I haven't done anything hidden or anything in the background since leaving off for part 1. So we are going to have a little bit of, tedium to start here. I don't want to skip anything. It's sort of this trade-off where if I skip things, you may be left wondering later on what I've done, even though I'm going to do some things that look familiar here. And if you need to fast forward through the video, then you fast forward as you need to do. So the last thing we did in part 1 was we built out Tom's RRSP. And we played around a little bit with asset allocation. I didn't go into full detail here, but we did manipulate asset allocation closer to retirement. And I said you could potentially do this on a formulas basis where you do something like you do a if statement, and you do at age minus a certain number of years, you adjust your cash flow or retirement age minus a certain number of years, you adjust your cash allocation, you adjust your fixed income allocation, and so forth. Not a huge thing. We're going to keep working through our list of expenses. You'll remember this is what brought us here. And really what we've just done at this point, we did Tom's fixed RRSP contributions. And we pop back here and we see, hey, a scheduled RRSP contribution. So now let's just match that up. Just back to an equal sign here. And we plug in Tom's scheduled RRSP contributions. We're not ready yet to deal with extra RRSP contributions, just like on our debt sheets. We didn't do any changes to the credit card balance. So now we've built out, and I believe we're done with it for the most part. When we get to retirement, we're going to have to play around with RSP and RIF withdrawals a little bit. That's a fairly complex area unto itself. We'll probably end up doing a little bit of manipulation there. But for now, we're good. We haven't yet built out Ann's RRSP. So I'm just going to drag that sheet over closer to my expenses. And I know I'm working with Ann's RRSP. I'll drag the data sheet over. So I've got everything sort of piled up nicely here. And for Ann's RRSP, I'm pretty happy with what we did with Tom's. So I'm actually just going to copy these first 2 rows over. Just grab them all, hit Control C, and pop back to Ann's RRSP, and I'm going to plug those back in here. And we're going to do our typical freeze panes here. And we've got whatever, we have to obviously manipulate this stuff. So Ann, let's say, has a starting RSP balance at $88,000. And she makes a little bit more money than Tom does. Maybe she puts a little more into an RSP as a result. We got $3,500 going in here. And no extra RSP contributions yet, no RIF withdrawals yet. So she's got $91,500 invested, which we're going to all plug in here. Different asset allocation. Maybe she's got a little bit different risk tolerance. Maybe we're going to go to 25% fixed income and maybe 35%, do 38%, and we can do 32% as her foreign equity component. So brought that risk tolerance down a little bit, and we can see that that does impact our average return, but everything just populated itself nicely there. We built a nice set of formulas for Tom, and it really did carry through nicely for Ann as well. And just like we did for Tom's RRSP, we can pop over to Ann's RRSP then, and we can just grab all that stuff. Oh, sorry, we do have to fix one thing here. I apologize. We have to make sure that we get the right amount in the RSP next year. So that's going to be the invested amount from last year less, sorry, plus any new returns that we've generated. And that tells us what we've got now for the next year. And you'll recall that Excel defaults to 2 decimals when it's in a currency, so we'll just get rid of that. And copy that over. Now, some of you might be asking here, what if we were to actually go over with RRSP contribution room? We can see it's not even an issue right now. It's something we really have to project out into the future in order to arrive at. We can actually do this. We can figure out the RRSP contribution limit. It's a little bit of a mess, but I'll show you roughly how this works. So we've got RRSP contribution limit. So we can start with a previous year's carry forward. Sorry, a little slop with my mouse there. We can look at previous year's carry forward. We can look at new room for the year. We can look at less any contributions made. And that tells us then for next year how much room we're going to have. I'm not sure exactly if we're going to leave that end of the year room in there or not, but we'll leave it in there for now. We know these are all going to be dollar signs, and I'm back to Tom's RRSP. You'll note I'm on Ann's RRSP here. I apologize. We'll copy this onto Tom's sheet afterwards. And we're going to make these all dollar amounts and just get down to our number of decimals. So let's say for the sake of argument, we look at Ann's notice of assessment and we see that she's got $62,000 of carry forward from prior years she hasn't been using. That wouldn't be unrealistic. That might be low, actually, given she's a relatively high income earner who hasn't been putting a whole lot into an RRSP here. We've got some new room available. So the new room is going to be, and this is where you got to watch this a little bit. Tom and Ann both earn less than the RRSP maximum income. RRSP maximum, if you wanted to track it for 2017, you could do this. It would be more of a concern if either of them made more than about $140,000. That's where we bump into this maximum. The RRSP maximum for 2017 is based on $26,010. Sorry, $26,010. That amount is indexed to inflation. We can actually, I believe we can go up to 2018 if you want. We do actually already know the 2018 amount is $26,230. And the reason for that is actually based on inflation from 2 years ago. It's a little bit wonky with how the RRSP works. There's a whole reason for it. It's covered in some other videos, not a huge deal right now. So I've got 2610, and that corresponds to, if you wanted to do this. And again, it depends how much math you want to do here. The nice thing about Excel is it's going to do so much of the math for us. That's just 18% of $144,500. So our new room then is going to be based on Ann's income. Where we put that, we're going to pop back and go grab her income. So we haven't done this in a while. Pull from Ann's income, and with your RRSP room, it is roughly based on gross income. There's some variability to that, but for our purposes here, that'll be sufficient. And of course, times 18%. So that gives Ann's new room. And then less any contributions made, well, that's going to be, contributions will simply be any scheduled amounts plus any new amounts. Easy enough. And that gives her end of year room, which is going to be 62,000 in this case, plus her new room minus her some of her contributions, and that's 76,140. Now you might note, if you want to get this sort of the way that I was doing it before, I'm just going to use Format Painter here. My cells didn't copy nicely. The Format Painter lets me take the format from another cell and move it into that cell, and that gives me a more uniform look and feel. Maybe you don't care. Maybe I shouldn't care, whatever. The thing that we have to note here, the new room can't be more than $26,010. Again, we know how to do that. We're going to use a minimum number. It's going to be the minimum between this amount and the amount that we calculated here, and that will stop us from going over the RSP limit. So this is something that we can do in order to check to see if there's anything out of whack or whatever the case is. We could build a formula in up top here to limit her RSP contributions to the maximum. Because it's a scheduled amount, I'm not so concerned about that, but with the extra RSP contributions there, once we get to the point where we're going to make some extra RSP contributions, I will build a formula in there to limit that. And now we've got all that where we're happy with it. I'm going to make the previous year's carry forward based on last year's end of the year room. Easy enough. For these other formulas, we can just carry them over. And for what it's worth, the RSP maximum, that amount is based on inflation. So I'm going to, it's a little bit difficult. Like I said, it's based on 2 years ago's inflation, but since we're using just an average inflation number anyways, not a huge deal, we can take that times 1 plus the inflation number that we used on our data, and it really is CPI that provides that inflation number, and we can close that out, and that should give us then a pretty good look at where RSP limits are going hand in hand with all the other stuff we've done. And now we're going to get that all ready. And ditto up here. And I like to build my formulas, get all my formulas working, and only then start to copy them across into later years. And now we can go and we can pull all of that. And we'll push that out to age 100. I have some cells here that are too fat for what they're supposed to be. And you can see that's because the decimals are in there. So I'm just going to go and I'm going to select the whole thing. I think this will work. No, I want to just do this then. Every place where I have those pennies. Oh, my formatting didn't copy across nicely. What a pain, eh? I'll select all of those cells where I have pennies. And now I'll knock that formatting down. There we go. And up here, the problem is that I'm just onto a 7th decimal place, so I just select the whole thing and go click on any cell, and it just makes all the cells fat enough to hold the information they need to hold. And we did this before. We could, with our RSP contributions, do something similar where we're going to actually stop RSP contributions in retirement. Same thing that we've done over and over and over again. So what I might do here is I say, all right, so this is going to, if Tom's age, and we'll do things a little differently here than what we've done if Tom's age is less than our retirement age, then we're going to make that 0. And otherwise, we're just going to refer to the previous year's value. Oh, sorry, I'm in the AND's RSP here. I should make that based on Anne's retirement age. Sorry about that. Anne's retirement age, I'll F4 that. And so if that's less than her retirement age, then we're going to have contributions continue. Sorry about that. And so then we pop back to her sheet and we say, all right, then it's based on the previous year. And I don't actually need the part where it tells me that that refers to Anne's RRSP. This is a little bit of a wonky thing Excel does, where if you're working in a sheet and you try to move back and forth between sheets, Excel wants to tell you it pulled that information from the one sheet. It's just something that's not necessary in a formula. And we say, hey, if she's over 35, then we're going to have, or over retirement age, then we're going to have 0. So what we should see now, sorry, something went funny there. Well, remember I said before that if you double click on the bottom of the cell, it copies down, and that's what just happened there. So I'm just going to do a quick undo for that. What happened was Excel thought I double clicked down here. I guess I did. I must have double clicked down there real quick, but I'm going to copy that all the way across. And we should see now that when she gets to her retirement age, that she actually does stop contributing to the RRSP. Perfect. So we've got that built out. Now we're going to grab the RSP contribution limit stuff, and I'm going to grab all 3 years of it here, and we're going to copy that over to Tom's RRSP, because we don't want Tom to go over either. And we can see that we do have to start with a new RSP carry forward amount. Let's assume Tom has 54,000 of carry forward room. His new room is going to be based on his income. Right now we have it based on Anne's income, so we do want to go and adjust that. We have that right now based on income B9. So if we just click up in the formula cell here and we pop over to our income sheet, we want to get that based on Tom's income, not based on Anne's income. So Tom's gross income is in cell B5, and we'll just go fix that on Tom's RSP. It's a little bit messy. You might have to, we're going to manually edit it here. I could have done it in the formula sheet. That was B5, I hope. Let's just pop back and make sure that's what it was. Yeah, Tom's gross income is B5. So now that'll copy across when we go and fix that. So right now we've got it based on income B5. We're going to make it, right now it's still based on Anne over here. So we just would copy that across, and now we're good to go. And his contributions, of course, are the 3,000. Perfect. The formula is pretty smart. It copied over for us. His end of year room is just based on what's on this sheet. The RSP maximum is the same for everybody, and the corresponding income is the same for everybody. So we are in good shape here, so far as I can tell. And now for Tom as well. We're going to pop up here, and we've got scheduled RSP contributions should be stopping in his retirement age, and I think we already have that. I think we're good for Tom. I think we just forgot to do that for Anne for whatever reason. Yeah, we're good for Tom. His retirement or his RSP contributions do stop. You see, I used a different formula for Tom than I did for Anne. Here I did a greater than or equal to. With Anne, I did a less than. Doesn't really matter. As I mentioned previously, there are many ways to address this same problem. So we have the RSP for both of them fairly well built out. Like I said before, there will be some modifications to make when we get to retirement, but for now we're good. So now we're going to do the TFSAs here. Just drag that over, and I can rename this as Tom's TFSA. So we really only working with our expenses sheet and our TFSA and our data sheets. I was actually pretty happy with how our RSP sheets worked out. So I'm trying to move that sheet over. There we go. And as such, I'm actually going to copy all of my first two columns here. And there will be some modifications to make, but we're going to bring those over. And we're going to start those off for Tom's TFSA and for Ann's TFSA. And it gives us a nice starting point. There is some stuff to modify, but we're okay. So we're on Tom's TFSA sheet here. So let's say Tom has a little TFSA. He's got $4,000 of TFSA room. And for the sake of argument, let's say Tom is putting $1,000 a year into a TFSA. Maybe they're treating it as a vacation fund or something like that. Got a little bit of money going into TFSA here. Oh, I never did finish up my expenses. We want to do Ann's fixed RSP contributions based on Ann's RSP. Sorry, one thing at a time. I apologize for skipping around there, but we did miss that step. Okay, so now, and we might as well do it now for Tom since we know where that's going to sit. We'll grab that. All right, and we should probably rename some of these things. That's now we're starting TFSA balance. Those are his scheduled TFSA contributions. And extra TFSA contributions and the TFSA withdrawals. And there we go. So we've got everything now situated properly. Previous year's carry forward is probably not as much for the TFSA as it is for the RSP. It could be, but let's say that Tom's used his TFSA a little bit in the past, like I said, using it as a vacation fund. So maybe he's got, we'll give him $32,000 of carry forward. And his new room is going to be, now this is a little bit tricky here. The new room here is entirely dependent on the background figure for the TFSA. And what it really is, it's $5,500 this year, 2017, of new room. It does grow with inflation. I'll show you in a moment how to take care of that. It's not obvious necessarily, and it is going to take a little bit more work than we might like, but that's okay. We've got whatever contributions are being made, and that carried over properly. And then we'd see our end of year room. This is where we're really going to work with this figure, and we know it's $5,500 right now. Doesn't matter about the corresponding income. That's really irrelevant. I'm going to come back and adjust that in a moment. Hey, I just realized that it's been a while since I saved anything. I'm just going to hit a quick save here. And yeah, the TFSA amount then, roughly the way this works, we're starting off at an indexed figure. Excuse me. Which is about $5,607 today. So we'll call it 5607. And that figure is indexed to inflation and then rounded to the nearest figure. So right there is $500. So I could do this all in one formula, but it's a little easier to do it this way, where I just take the previous year's number, and we're going to do the same thing we've always done, multiply that times 1 plus inflation. And it is directly based on CPI. And I have to remember to F4 that to put my dollar signs in there. And we're good to go. We want to make that currency, and we want to shave some of our decimals down. What really happens then is the actual TFSA maximum is based on that figure to the nearest $500. This is where we're going to use what's called mround. And that's a function that Excel has where it'll round something to the nearest of a given dollar amount. So I want to round this value down here to the nearest 500. And what will happen then, Excel will take care of me. And you can kind of watch your TFSA limit grow that way. It's not going to be perfect because inflation is not going to be that level 2% a year. And in fact, over the last year, inflation was at a really, really slow pace. But you can see here kind of where TFSA limits might grow depending on how inflation actually works out. Okay, so we then would look at our actual new room is going to be based on the number we did down here. I didn't need this extra formula down here, but I'm not presenting this to the client. This is just something sitting in the background, so it's not a huge thing. We've got sorry, I want to do my previous years. Carry forward is going to be, or sorry, this amount's going to be based on that amount right there. And we don't have any contributions made yet, so we can plug that all in, carry that all the way across. We want our TFSA balance to be based on what we put in there. So we had in there last year, plus our investment returns. Just like so. And then we want that formula to copy all the way across. And I'm not convinced necessarily that we want to treat our TFSA the same way that we treated our RRSP. Let's assume that TFSA contributions continue into retirement. There can be reasons to do that, depending on where you're sitting with your RIF and TFSA and your tax rates in retirement. So that becomes more of a financial planning problem that we can use this to help us solve, but we'll leave it as it is for now. So we really have, yeah, everything good to go down here. Now, as I said for Tom here, Tom is not using his TFSA very aggressively. He's using it, let's say, all for retirement, sorry, all for short-term stuff. So he's just got it all sitting in cash. His returns here would be fairly negligible. That might even be optimistic, but that's okay. Long-term, we should see some return on cash. Not a big deal one way or the other right now. That $50 isn't going to make or break his financial plan. And we can take all those numbers and we can copy those all the way out. Just like so. And I think I forgot for Tom and for his RSP here, we're going to do the same thing we've previously done. We're just going to do the freeze panes, and then it's easier to follow all of this going across. So that's Tom's TFSA pretty much done. Withdrawals for the TFSA are much easier than they are for the RS or for the RSP, and we'll see that when we get into retirement. And we're just going to copy that all the way across. All right, and yes, there will be a ridiculous amount of TFSA room available for Tom by the time he gets to mortality, assuming he just carries on like this. Okay, so if nothing else, it's this kind of little trick, this TFSA rounding thing, that you can show somebody to actually get them to understand what's going to happen with TFSA limits. Okay, so we're going to copy all of that. Again, pretty happy with that. We're going to copy all of that, and we're going to take that over to Anne's TFSA. And let's say Anne's done a little bit more with her TFSA. She's got $8,000 in there, and she puts in, we'll call it $1,800 a year into her TFSA. I really should base that on the previous year, like so. And she's actually investing hers, so we'll give hers more of an investment component. Remember, she was a fairly risk-averse investor. Maybe with her TFSA, she says, I don't want to take a ton of risk there. And maybe we do something like this. And I think we're all good down here. And we should be able to just go and grab all of those rows now, all of that information, and copy it all the way out until Anne's retirement, or until Anne's mortality, sorry. And again, we'll just do a freeze panes back here. I think we're all pretty straightforward. And you can see where once we've built out one bit of information one way, it's not that hard to take that and manipulate that for somebody else, as long as it worked right sort of the first time around. Now I'm going to do one of my interim saves here. And I'm going to save this. And I like descriptive titles, so we're going to do sample Excel to TFSA contribution. And that allows me to go back and find this now if I need to do sort of a recovery type of save here. I can go and find that later on. Now, we actually haven't finished this out yet, so we want to look at Anne's TFSA contribution based on what we did over here. And now we're good. And for Tom's TFSA, I realized as I was doing Anne's that I didn't do this exactly how I'd like to do it. This should really be based on the last year's figure, and then we'll carry that all the way across. And now we've got our expenses. Now, some of these expenses are going to index and some of them are not. This is where I see a little bit of a gap in how I did things. One of the places that indexing is a little bit weird is with insurance premiums. There are some insurance premiums that are indexed to inflation, home insurance, auto insurance, and health and dental benefits are generally inflationary costs, whereas life and disability insurance are generally not inflationary costs. Now, if your disability insurance is part of a work plan, then if it's employee paid premiums, that portion might be inflationary. So what you might want to do here is you might even want to break this out. And it's not a huge deal, but for those that deal in the life insurance world, it actually it can be kind of a selling feature, for lack of a better term. It's a nice budget management item that your insurance premiums for most kinds of life insurance contracts are non-inflationary. So I might break this out. Just like so. I'm really having trouble typing there. And I might put one of my little comments in here. For some reason, Excel's not excited about me putting a comment in. So inflationary would be health and dental. And I can't remember where I did my homeowner's insurance, but my home insurance and so on. Did I put, yeah, so my home insurance is down here and my non-inflationary stuff is going to be That's going to be my life and disability insurance. And now I'll break those out accordingly. Maybe 4,200 here and 4,000 here, or whatever it breaks out to. Now, as I said, some of these expenses are inflationary, so my fixed expenses probably inflationary. We're going to take the previous year's value times 1 plus that same inflation number we've been using over and over and over again. Now, if I had broken out education and healthcare costs separately, which might be appropriate in retirement, we can see that there's different inflation items there. And I might do that. I might break this out where we say, where we put healthcare here. So I might break this out where we're actually going to, because we did a separate rate of inflation for healthcare, and maybe we look at our healthcare costs, and 11,000 of those here and 2,000 are healthcare costs. And now we're going to use that different inflation number. And we pop over to our data and we grab our healthcare costs. And we just F4 that and close that out. And my housing expenses, so heating and property taxes and so forth, I'm going to assume this just inflates at normal CPI, that when we talk about housing costs, we're talking about when we talk about housing costs back here, we're talking about the actual price of a house. And I know that's not perfect, but that's one way we can do this. Again, it depends how much fidelity you want to build into this. So our housing expenses now, we're going to inflate that the same way that we inflated this guy up here. I'm just going to copy that formula down. And that should be all based on the same inflation number. We're good. And my transportation expenses, same thing. We're going to copy that formula and plug that in like so. My lifestyle spending is also going to be inflationary. That might include my education costs. And then again, I would break that out. I think we get the idea. This is going to be inflationary. This amount is not inflationary. It's just based on previous year's costs. And for my credit card payments and so forth, I want to make sure that I base those on what's in that cell. So if I just copy that across, we should see that now that's based on C5 and so on. So it's going to always look like the appropriate cell. If I base it on the previous year's value, that's not always going to be right. So I want to make sure it's actually referring to the right cell on the right sheet as I pull those over. Again, one of my double clicks happened there. I'm going to just undo that, and we can copy that over. And there we go. And then I can pull my total expenses, and that's going to sum out over here. So, and the difference here, we see a difference like this. We should make sure we can identify where that difference comes from. And we sure can. My extraordinary expenses, there were 9 in that second year for whatever reason. So now we can pull all that over that. Sorry about that. It's not cool. We can pull all that over, and we can fill all that in. Extraordinary expenses are all going to have to be manual, at least for the time being. I'm not going to fix that at any point where we're together, but you may have some extraordinary expense like renting a car, or sorry, purchasing a new car where it happens every 4 years and you're going to put in a down payment every 4 years. There are ways to do that with Excel, or you could just do it manually. Now we can see that we have all of our expenses projected all the way out. We didn't ever work with any non-registered investments. We may or may not have to. That's really no different than what we would have done as far as the TFSA goes. We'll plug those in back at the end here as sort of a holding. And the house, we didn't do anything with the house yet either. So we can play around with this a little bit. We can look at the value of the home. Now we already did a place for the mortgage. We'll come back to that in a moment here. We can look at appreciation on this thing, and that's where we're going to use that data that we just pulled. And we can look at the mortgage here, and then we can look at something like net equity in the home, which could be useful from a financial planning perspective. So the value of the home, we need some sort of assumption here. I can't remember what I put the mortgage at. That's probably a good indicator. So $480,000 of mortgage principal. So let's assume we've got a house recently purchased, and we'll put the house then at $550,000. And again, I want to make sure that Excel knows I want to do all of this in currency and get rid of those 2 decimals that I don't need. Appreciation on the home is going to be based on this value times this is where we're going to use that housing appreciation or housing costs, and we can do that accordingly. And the mortgage, this is simply going to be based on the outstanding value of the mortgage in that year. And our net equity in the house then is going to be based on this amount plus this amount minus our mortgage. It's going to give us a rough idea what that equity in the house is. And now we can just build the value of the home is simply last year's value plus last year's appreciation. Our appreciation, we do want to plug that F4 in there so that that consistently applies. The mortgage and our net equity, so we can build those out all the way across and just grab those 4 cells and run those out. And we should get to a point where the mortgage is paid off. Or where the house just continues to appreciate. So yeah, we got the mortgage paid off here, no more mortgage, and now they have the entire net equity in the home as their own asset. Okay, I hope that that gets us to where we've got to be as far as building out all the underlying values. And now finally, we're going to go back to our multi-year cash flow sheet. And we already built an income sheet in here. So we based this on our total income. We had a total amount of income down here. And now we're going to build an expenses row in. And our expenses should be based on, again, our total expenses, not too tricky here, nothing difficult. And we can build that all the way across. So now we have income and expenses for those years. And of course, this becomes significant now. We look at, okay, we've got income, we've got expenses. We should be netting those 2 amounts out. So do we have a surplus or deficit? And we're going to take those amounts. Not surprisingly, we have a deficit. And what I might even do here is, I'm a fan of this kind of thing. You may not want to, but you can actually format this row here where we say, hey, if it's going to be a negative number, we're going to make it currency here. And if it's going to be a negative number, we can do it in red. We can do it as a negative. I'm going to keep it as a negative like so. And I'm going to get rid of my decimals again. But I still might want to be able to see this in red. So this is where we can, and this is a little fancy maybe, this is where we can do something called conditional formatting. And we're just going to do a new rule here. And we're going to say format all cells based on their values. Yeah, okay, that makes sense. And we just want a 2-color scale. Sorry, I apologize. Just bear with me for 1 second here. Sorry about that. So we select that, and we're going to do some conditional formatting here. We're going to do a new rule, and we're going to do format only cells that contain. We're going to do cells with values, and we're going to do less than, and just type in 0 here. So now it'll be anything less than 0, and I just have to hit format. And I'm going to make this a bright, obnoxious red, just like so. And now I can see any deficit year. And I'm going to put a little note here. So positive number is a surplus, and a negative number is a deficit. And we just copy that all the way across. And I'm just going to do a quick save here. Nothing fancy. So we can see some years of negative income, all related to those extraordinary expenses, and some years of positive income or positive net income related to our lack of extraordinary expenses, essentially. So now the question is, where does that surplus or deficit go? And this is probably the most challenging part of building out the accumulation years. Now you can get very fancy with this, but we don't need to get very fancy with this. What I would suggest here is that where you have a surplus, you're going to use that to pay down certain debts. And this becomes a little bit of a financial planning decision. So I say, well, I'm going to pay down credit card 1. And this is going to correspond to what we did on the sheet for credit card 1, where we had that space for extra payments. We're going to do credit card 2, extra payments. I'm making a decision here as to the sequence in which I want to pay things down. And this does sort of support a snowball method or potentially even a highest rate method of paying down debt. So you pick which debt you're going to pay down. You pay down that one first. We're going to do line of credit extra payments. Then we're going to do mortgage extra payments, potentially. You may not want to pay down the mortgage. Again, this is a financial planning decision, but I'm going to build in the opportunity to do so. And then we're going to say, where are we going to put extra money? Well, we want to put some extra money into, again, we'll do some financial planning, and we'll do that separately. So the sheet here supports my financial planning, but I really should be figuring out what's best for my client, using in part the information on the sheet, using tax calculations and using their preferences, using when they're likely to access funds and so forth. So let's say based on all of that, we arrive at the decision that we want to get Tom's RRSP cranked up a little bit. And then we want to get Ann's RRSP cranked up. And then we want to build up the TFSA. So it's just a matter of choosing my sort of sequence here, and I'm not stuck with this sequence. This just gives me a rough idea. Now, we can see that we also have some years when we have a line of credit that's going to impact us negatively. So maybe I shouldn't say extra payments, but maybe I should say something like impact on credit card 1, impact on credit card 2, impact on line of credit, and impact on the mortgage. What I'd prefer to do is when I have this deficit in year 1, I'd like to see that go to the line of credit. I think that probably makes the most sense. But when I have a surplus, I'd like to get the credit cards paid down first. So how do we do that? Well, actually, I'm going to leave that how I had it. I'm sorry. And I'm going to say, I'm going to build in another row here. And we're going to build another row for line of credit or add to line of credit balance, something like that. There we go. So that should really be my first thing for a negative amount. Now, if I exceed my line of credit balance, now we have to start going to the credit card. We can formula all of that out, and that might be necessary, but let's just use the line of credit for now. So what happens here? I have a negative value. So with that negative value in there, I'm going to do a little if statement. And the way I'm going to do this if statement, I say, all right, if this amount is less than 0, so if B6 is less than 0, then I'm just going to put B6 in this cell. And otherwise, it's just going to be 0. So we can just run that out over a few years. We make sure that works. Hey, perfect. So we're not going to touch the line of credit balance in a year when we have a positive balance here, but in a negative balance here, we're going to dump that onto the line of credit. So now, I'm just going to drag my line of credit sheet over here. Now I look at my line of credit sheet and I say, all right, we are going to build some line of credit here. We're going to use the line of credit based on what happens on the multi-year cash flow sheet, just like so. And I'm just going to copy that all the way across. Now it's going to be wacky at the end here, which is fine. So it's what we would expect. There is no payments being made on the line of credit. And because there's no payments being made on the line of credit, just the balance builds there. That's fine. Not too fussy on that. So our line of credit interest here, well, that becomes now our, that's our interest based on the amount that we built on the line of credit. And it makes sense. Now our line of credit scheduled payments, this is where I have to adjust this a little bit. I shouldn't be making a scheduled payment unless I actually have a scheduled payment coming from somewhere. So I'm not necessarily happy with that. I'm going to set my line of credit scheduled payments to 0 all the way across. And there we go. So now we still have that same formula, but because I started at 0, I don't have a line of credit scheduled payment amount. Now, what I really do have to be doing with a line of credit, I do have a minimum payment that has to be made. So we do have to actually make sure that we're paying at least the amount of interest. So let's plug in a row for that. So we're going to put a minimum line of credit payment in here. And that's simply going to be based on my interest for that line of credit. And we'll plug that all the way across. Now what's going to happen, the line of credit balance for 2018 should be based on the amount that we had that B4 minus any scheduled payments, which we don't have any of, minus any change to the line of credit. Perfect. And because it's minus a negative, it actually adds to the balance. And then we look at the line of credit interest. And the other thing that's going to happen here is we're making a little payment based on that minimum line of credit payment. So we copy that across. And what should end up happening is that should basically make it so that we don't grow the line of credit like so, that we're just going to end up with a line of credit where we're just paying the interest every year. And again, the timing isn't always perfect here. For the purpose of long-term projections, though, I think we're okay. So now we get the line of credit built up. Now we don't have any line of credit amounts being paid in addition to that, but that's all right. So right now, everything is as it should be with the line of credit. We pop back to our multi-year cash flow. We're going to run that all the way across. Okay, and what I like to do here is I like to just have sort of a running total, for lack of a better term. This is going to let me make sure that I'm allocating all of my $5,360. So what should happen here, that 5,360, I'm going to take that amount, I'm going to subtract everything below it, and I should get a 0 here. And what that really is going to do, that's going to help me to track all this out. Now, I'll add and subtract from that formula as we work through this. We're just going to work with this first 5 years for the time being. And I'm just going to do a quick save again here. All right, and then we're going to look at getting some money paid towards those credit cards in the following years. It doesn't make any sense this year to do that. Now I'll build the formula and then we'll copy it back across. So I say, well, first thing we want to do is we want to get that credit card paid down. Makes more sense to pay the credit card down than the line of credit. Oh, and sorry, one thing I should do here, I just built my line of credit. I have money going to my minimum payments here, but I actually didn't reflect that on my expenses anywhere. So that really is an expense that we have to deal with. And we're just going to drag the expense sheet over here for the time being. And what we're going to do here instead is we're going to do minimum payments on the line of credit. And I think this will work. I'm a little concerned about a circular reference here. So this is a good opportunity to show something here. This is a fairly simple version of what can be a very difficult problem. So I change this to minimum payments, line of credit. And now I say, well, I want to base that on my line of credit minimum payment back here, which is $268. But Excel says, hey, dummy, you've got a circular reference in here. And the reason that there's a circular reference, and Excel tries to be helpful with this little set of arrows here, but honestly, it's not that useful. The reason there's a circular reference is because my total expenses down here, which Excel does try to show me, is actually being used to determine my surplus or deficit, which is then being used to determine my line of credit balance. There is a way to sort of hammer Excel into not having a circular reference, where it does this complicated thing. It does like 1,000,000 calculations and determines the average and says, well, we figure that the circular reference isn't that big a deal then. But there is an easier way to fix it. And it does involve a little bit of shoehorning, which is okay. All I'm going to do, go back and get rid of that circular reference thing. So I'm just going to do a Control Z. I'm going to undo the last change that was made. And what I'm going to do, I say, well, really the minimum line of credit payment, I'll make it the year after. So I'm instead going to base my line of credit, my minimum line of credit payment on last year's interest. I'm not going to base it on this year's interest. So I'm going to do this like so. And now Excel will cooperate with me a little bit better. It won't give me that circular reference problem. It's a little bit artificial, but it's not a huge problem. That is one way, the easiest way generally to fix a circular reference. You're going to get a circular reference at some point working through this. It's almost inevitable. It's nothing to panic about. Just go back and find someplace where you can sort of shoehorn something in like I did there, where you're going to use a different year's value. Not a huge concern. So now we're going to pop back to our expenses. And now I'm going to make that based on, like I just did, that minimum line of credit payment amount. And I'm going to copy that all the way across. I should not get that. Sorry, that was Excel. Not liking my double click there. For some reason, Excel is really sensitive, or my mouse is really sensitive today to that double click thing. All right. So now we've got it. We're good, and we can see the actual interest becoming an expense, which does change our multi-year cash flow over here. We actually have a smaller surplus available than we had a moment ago. I'm going to save everything because I feel like getting that circular reference thing hammered out was a little bit of a victory. All right. And I want to get that surplus now towards my credit card. So I say, well, if I have a surplus and if I have a credit card balance, then I want to take that surplus and pay it towards that credit card balance. And I do have both of those things. I have a surplus and I have a credit card balance. So credit card number one has a $12,000 balance. And what I'm going to do here, I want to say, well, I'm going to take the largest of those amounts, or the smallest of those amounts. So I want to do the maximum of 55.55. No, the smallest of those amounts, sorry. The minimum of 55.55. Now I'm going to run into a problem in a second here. I'll show you. Nothing to worry about yet. And the credit card balance. And I'm going to pay that towards my credit card balance. So this year, again, we're going to pay that towards our credit card balance. But I'm sure you can see what's going to happen in a second here. The smallest number here is going to be negative 861. That's going to influence my credit card balance now. Now, that's actually pretty easy to fix because what I can do then is I also say that I don't want this number ever to be a negative. So I say we're only going to do that. We're only going to use that amount towards the credit card balance if this amount is greater than 0. And only then will I use that formula. If that amount is less than 0, then I'm just going to use that 861 somewhere else. So now I have a formula combining an if and a minimum, although not that complicated. The formula is still relatively easy to follow, where I've got my logical test, my value of true, my value of false, and I can wind that up. Now, I'm sure you can start to appreciate just how complicated you can make Excel, but we're okay. Now you see what happens here is we only put $10,214 towards the credit card this year, even though we had a $10,666 credit card balance. I'm sure you figure out what's happening here. That's actually going to have the credit card paid off at $10,214. Now, I didn't know where the changed credit card balance would come in until I built that sheet out. So now I can use this changed credit card balance. I can pop back here and I say, hey, look at that. We've got a place to refer to now, and we should see our credit card get paid down quickly here, or quicker, where we're actually applying those changes to credit card balance against our actual credit card balance. So in the last year here at age 39 times age 39, 1598 minus 1598. Hey, look at that. Presto, it's paid off. And I think you can see now where this is going to take us. So that means that I've got, just pop down here for a second, and I said I want to get this to be negative. So I'm going to change my running total formula now. I'm going to make this B6 minus B11. And we're going to add B7 in there as well. So now, copy that across. And hey, look at that. I have no surplus in those years. But of course, we're going to see some surplus still over here. So now I've got to still get rid of that surplus in those later years. I said I'd only do 5 years, but I guess we're going to do 7 years here, 8 years, whatever that is, 7 years. So now we want to start working, chipping away at our credit card number 2. And we're simply going to take the same formula we used up above here. I really only want to do this if I've got a 0 balance for my credit card extra payment. Now, there's a couple different ways you can do this. I called what I did down here a running total, and sort of the easier way to do this in order not to get us real messy is actually to build, and I'm going to hide this later on, but to sort of build in another row here where I'm going to do, okay, leftover after credit card 1. And that sort of tells me what I have left now after credit card number 1. And so I'm just going to take, for leftover after credit card number 1, I'm going to take what's up here minus what's down here. But I'm only going to have that if that's greater than 0. So really, only if this amount is a positive number, and otherwise I have nothing left over here. And you can see where this is going to have an impact, which is over here. I got that $12,896 left over after credit card 1. Now, I don't necessarily want that showing on my multi-year cash flow sheet. Later on, I'm going to hide that so it doesn't look messy, but I'm going to leave it up there. So hide is just, to hide something, you just right click on it and you click hide. And then to unhide it, you can do a couple different things. You can go hold your mouse over and select it, or the other thing you can do is you can select the things that are north and south of it, and you can click on unhide like so. Okay, so now credit card 2 extra payments. And really, I'm going to use the same type of formula we used up here, where I say, all right, so if this amount now is greater than 0, then we're going to use this amount to pay down the credit card. So now, if that amount is greater than 0, which it's not in this case, but it will be later on, then we're going to use the minimum of that amount, or as we previously did, the balance that we see on credit card 2. Oh, and I forgot to finish this out. Yeah, so I did my if here. I did my logical test. I did my value of true, but I still need my value of false, which is going to be 0. So now, credit card 2 is getting paid down. And we're going to get to the line of credit eventually here. So now I'm going to do another sort of tracking row here. Insert rows, and I'm going to do leftover after credit card 2. And my leftover after credit card 2, I just want to take this same formula and basically apply that here. So now I can say only if that amount is greater than 0, then we're going to take what we had left over after credit card 1 minus our credit card 2 extra payment. And I forgot to put my 0 in there. And we copy that across. And now what I haven't done yet, I haven't actually taken this credit card 2 extra payment and applied it to credit card 2. So now we go to credit card 2. We say, hey, I'm ready to start paying this thing down. We're going to pull that out of my multi-year cash flow sheet. Oops, out of my multi-year cash flow sheet. And we should get that credit card paid down now. Look at that. We are going to have $12,896 available. All at one time, we're going to get that credit card paid off way out there in the future. 6 years out. And until then, we're just going to make our scheduled payments. Okay. So now, starting in year 7, 2023, we have a whole bunch of money left over. And of course, we're going to do the same thing now. We're going to put that towards the line of credit. So how do we determine what goes towards the line of credit? Well, we're going to use, again, this type of formula as our basis here. So if we have a surplus or deficit, oh, I forgot to put my equal sign in there. That's not helpful at all. If we have a surplus here, if that amount is greater than 0, then I'm going to take, again, that same thing, the smallest of the amount left over here, and the amount that we see sitting on our line of credit, the line of credit balance. And 0. And we can copy that formula all the way across. So now we should be seeing an $8,616 line of credit balance out in 2023. And I want to just pop back to the line of credit now. And we have our line of credit. And we want to make another payment on that line of credit. So what I can do here, I already have this place where we're building the line of credit based on a negative value. So we've got multi-year cash flow B13. So that's a negative number impacting my line of credit. And what I might do here, I think this is going to work, plus whatever we have in multi-year cash flow B11. And let's just see here. I'm honestly not sure how that's going to work out. Yeah, there we go. So when we have this extra balance out here, 8616, we've got it paid off. And now I'm just going to copy that all the way across because I'm happy with that formula. All right, so we've got the 8616 out here. That amount has paid off our line of credit. We got no weirdness happening with the line of credit. It all makes sense now. No interest because that year we've covered it off. We're good. And we pop back here. And I'm not concerned about my expenses sheet because really what I'm doing with these extra payments is I'm treating these as amounts that are distinct from our expenses. So we have a surplus or deficit based on our income and expenses, and then what are we doing with that surplus or deficit? That's why I'm not manipulating the expenses sheet. Now, mortgage extra payments, I'm going to leave this blank for now. I am going to put a row in here for my leftover after line of credit. I'm going to assume that we're just going to let the mortgage run out, but I do want to make sure that I take my amount left over after line of credit so I can take, and really I don't even have to worry about my negatives now. I'm working with leftover after line of credit minus that, or leftover after credit card 2. So I should have, yeah, about 10 grand here still to use. And we haven't done any saving stuff with it yet. So I'm going to put a quick comment in here. Assume we just let No extra payments to the mortgage. We got a nice low rate on it. We do a little financial planning off to the side. We determine with everybody involved that we're happy to carry the mortgage out until maturity. And we'll plug in zeros here just so I have something. And now I do want to make sure that I capture everything properly in my running totals. So this is where I say, really, this is going to be, we're going to add to this amount any amount that we paid to credit card 2, any amount that we paid to the line of credit, and any amount that we paid to the mortgage. And we should see a surplus over here of 10,666 because we haven't allocated that anywhere yet. Now I'm going to save this, and this becomes a very similar concept now to what we saw with our paying down debt. Now we're going to take that surplus. Now that we've gotten to a position where our client is in a net surplus, the 10,666 here that's left after all our debts covered, and we're going to use that to build out the RRSPs and TFSAs within the bounds of the room that's available. So the first thing we're going to do is we're going to get Tom's RRSP up to its maximum. Now we're going to play around over here, and then we'll copy the formula back across. So I want to get Tom's RRSP funded. So I've got $10,666 available. I don't want to go over the limit though. So what I'm going to do is say, well, we're going to take that amount left over after the line of credit's paid off, and we're going to put that into Tom's RRSP. We're going to use that amount. All well and good, but I don't want to go over the RRSP max. So what I really should be doing here is I should be choosing the minimum, the smallest amount between $10,666 and Tom's RRSP maximum in that year. That's going to be year H on Tom's RRSP. And you can see where I now have to flip way over here to go find Tom's RRSP. And year H, Tom's RRSP room that's available is going to be $131,379 plus the new room that's available, less the contributions made. I could actually use that amount instead. And that prevents me from going over now. Now I do want to bring that $10,666 into Tom's RRSP. I'm going to drag that sheet way back over here. Now we pop back to Tom's RRSP here. And we say, all right, we better make sure that we've actually got these extra RRSP contributions accounted for. So now I know where to look for those. We're going to go and find those on the multi-year cash flow right here at Tom's RRSP. And we're going to copy that across. And we should see when we copy that across, oh, I got a circular reference on the RRSP room. And just bear with me for a minute. I'll go find it here. But we can see where there is a circular reference here because the amount of income dictates. So this is where, again, I'm going to simply use the prior year. So again, that's a sort of quick and dirty workaround for this, where I just say, we're going to make our extra RRSP contributions based on the prior year's amount, which actually isn't that wacky anyways, because really that surplus isn't available until the year end. So now I can copy that across, and I shouldn't end up with a circular reference here. And we've got perfect $10,666 going into Tom's RRSP. That's going to impact the RRSP room here. We can see that that 145,000 doesn't grow by that much now. We were getting big growth in the unused RSP room, but now we've used most of his RSP room. And now we want to make sure that we don't get into an over contribution situation. So what I'm going to do now, I'm going to take that formula. We're just going to copy it back across here. Oh, sorry, that's not what I want. I want to copy the formula across. Oh, that's where our problem is. Right. Okay, there we go. Yeah, we're good there. Okay, so now we put that money into Tom's RRSP, and we're going to build out a few more years here, because eventually we're going to get to a point where Tom's RSP does get maxed out because of this. Now, I had warned you before that Excel has this tendency to do this, and it did with my mortgage here. I don't want that to be growing by ones or whatever the case is. It should be zeros all the way across, but thanks for being so helpful, Excel. Let's put those zeros all the way across so I don't run into that problem again. Not that it's a huge deal, that extra $14 on the mortgage or whatever, but it's weird. Okay, so now we get to a point where if I apply my running total, I can see that I'm going to bump into a problem here. And what I really should be doing now is taking my running total and saying, well, now we're also going to add Tom's RSP to that amount. And it should be zeros all the way across, but it's not going to be. We're going to get to a point where Tom's RSP room runs out right here at age 52. In 2034, that's where we've got basically Tom maxed out on his RSPs. Now, you might not want to max out Tom's RSP all the way. You might want to use ANDs a little bit. Whatever the case is, you can build your maximum formula to accommodate that. I use Tom's first because he's the lower income earner, but at some point it probably doesn't make sense just to absolutely max that out. However, that's what we've done here. And if you had a larger scheduled amount going into AND's RSP, this would be less impacted. And maybe what you want to do is when you get out here, when you get to the point where Tom starts making RSP contributions based on a surplus, maybe you change the scheduled amount of AND's RSP contributions. Again, you can build a formula to do that. So now that we've got Tom's RRSP built out, we're going to go have a look at AND's RRSP. And we really are going to do the same kind of thing we did for the debt up above here. We're just going to build in another row that we will later on hide. And we say, okay, what's left over after Tom's RSP? And it just becomes whatever we had left over after the, I guess after the line of credit. Yeah, left over after the line of credit, minus whatever we just put onto Tom's RRSP. And we can copy that across. And it should be zeros here. And we should get to a point way out in the future here where, yeah, there we go, where we have leftover amounts which are not being allocated. And we're going to put those onto AND's RSP. We're going to do the same thing that we previously did. We're just going to start with a 0 here, and then we're going to basically steal this formula where we say it's going to be the smaller amount between Ann's RSP limit and the actual amount available here. So it's going to be an equals minimum between the leftover amount and we're going to use Ann's RSP balance from the previous year. And got Ann's RSP maximum here. Oh, not helpful, Excel. Not helpful at all. Just like so, and that should work out for us. No circular reference or anything like that. So now Ann is similarly going to be maxing out her RSP to the extent that it works. There we go. We've got Ann now putting money into her RSP. Now I think what I forgot to do here is I forgot to actually show the RSPs growing based on those extra amounts. So we'll sort that out in a second. I'm going to drag Ann's RSP over and put it closer to the front here. So do we have Tom's RSP growing based on the extra contributions? We do, yeah. And for Ann's, then we better do that same thing. So now we know where Ann's extra RSP contributions are coming in. Just going to base that on our multi-year cash flow. And actually, this is a frequent mistake that I see people make is they jump to another sheet. They don't go back to the initial column. They choose whatever, something way over here, and it really messes up your math quite badly. So make sure you're always going back to the far left side. So our extra RSP contributions now we should actually see and start to build out a little bit of RSP, and there it is. And just make all those columns fat enough to fit their information. But yes, we can see Ann has these extra RSP contributions now up to the point that it makes sense for her to do so. So we're contributing to Tom's RSP, we're contributing to Ann's RSP, and we have money in both accounts. Now, in this case, we're not going to have any extra dollars left over for the TFSA. Again, you might want to do something like maybe you build a formula into the TFSA where you say, hey, when the debt is paid off, we're going to increase the scheduled rate of TFSA contributions. And I'm going to show you how to do that. So I'm not going to use the TFSA exactly the same way that I use the RSP. Oh, sorry, I want to fix my running total here too. I want to make sure that that's all adjusted accordingly. And now we're going to add in Ann's RSP contributions as well. And we're going to carry that over. And we'll come back and do my TFSA fix in a moment here. I just realized we didn't finish out all of these rows. And we're going to continue to do so all the way across here. So now we're actually building out, I think, everything all the way across. The TFSA. So the way I'm going to do this, I'm going to treat this a little bit differently here. That's what we didn't finish. We didn't finish Tom's RSP here. And there will still be some contributions to Tom's RSP going forward because he does have new room each year, just that now he's only contributing up to his 18% of his earned income. So what I might want to do, just going back to my TFSAs now, it might make sense to do something like this. And again, this is maybe a little bit fancier than what you want. I don't know how much you want to do this kind of thing, but you might want to say, well, that scheduled TFSA contribution, we know that the last debt we're going to pay off is the line of credit. So I might want to set this to $1,000, But what I might want to do is something like this, where I say, we're going to choose the larger amount, or sorry, we're going to do an if here. And we're going to say, if we still have debt on the line of credit, then we're not going to touch the TFSA. So I say, or we're not going to touch the TFSA beyond that $1,000. So I might say something like this, where we attach this now to the line of credit. So I say, if the line of credit balance is greater than 0, then we're just going to use that previous year's value. Then we're going to use what was cell B5 on the sheet we're working on, the previous year's value. And if it's not, then we're going to change it up. We're going to crank it up to, let's say, $2,000. Something like that, where we increase, or maybe even 3,000, whatever. We'll do it like that. And so if the line of credit balance is greater than 0, oh, sorry, and I should do it. I don't necessarily have a line of credit there. I apologize, because I should do it if it's any debt that's going to be greater than 0. So maybe we do, and this is where this gets a little bit more complicated, but we can do an or statement. And I had intended to stay away from or statements, but here we are. So I might do an or just means that it's going to build in a bunch of different conditions here. So one of my conditions, my logical one, is line of credit is greater than 0. I want to do the same thing for the credit card. If the credit card balance is greater than 0, and I want to do the same thing for credit card number 2. If that balance happens to be greater than 0 as well. So now I have this whole string of or conditions. So I got if, and the logical test now is if any of those things, or you can do the same thing with and means they all have to be true, then we're going to use B5, and if not, we're going to use 3,000. And 3,000 is just a number that I made up to represent what we would do if those are all paid off. So now you should see that oh, sorry, what I should be doing here is I should be changing that not to B5, but I should be doing 1,000 in there. And the reason for that is because when I get way down the road over here, it's still referring to the previous year's value, and I want it to do 1,000 in there. I want it to, I do have a line of credit balance over here, and it kind of dominoed through. There we go. So the only time we should be putting $3,000 in here is kind of pre-retirement, when they haven't started using their line of credit again, at least yet. So now my scheduled TFSA contributions, and what should have happened is that should show up on my expenses now, where we have our scheduled TFSA contributions, and there they are. And we could do the same kind of thing for Anne, where we say, basically we take the formula we just used for Tom's TFSA. And I'm just going to copy that formula. Now we're going to go over to Anne's TFSA, and we're going to do something very similar here, where we say, and she was putting 1,800, not 3,000, and maybe we can crank hers up to 3,600. And so we say, yeah, Anne is only contributing to this when the line of credit is not being, or sorry, when the various debt faculties are not being used. And she was going to be 1,800. Oh, sorry. Somehow I copied that onto Tom's. I'm just going to undo for a second here until I get where I'm happy. All right. And we want that on Anne's TFSA. did there, and Control V. There we go. And now we're going to fix that up. We're going to say that should be 1800 or maybe 3600. So we're going to double hers. And we should see hers jump to 3600 again in a year when, when the debt's all paid off. That's good. And then jump back down to 1800 when we start to accrue some debt again. Perfect. So you can see where you can get pretty fancy with this. And again, it's just a matter of building one step at a time. And what happened here, because I made my expenses dependent on those scheduled TFSA contributions, I don't have to do anything else too fancy here. I've got now my total expenses are going to increase when I have more money going into the TFSA, and that would have the domino effect that I don't even have to worry about of influencing everything that happened on my multi-year cash flow. And you can see where this gets pretty kind of fancy now in terms of what we're accomplishing. Now, I'm just going to hide these things away right now. I'm going to hide away Tom's TFSA and Ann's TFSA. I'm going to hide away these leftover amounts, all these leftover amounts, just for the sake of aesthetics, really. And now we're in pretty good shape, actually. We've built out all of our accumulation vehicles. We've built out our debt repayment. We've taken into account that income is going to stop when we get to our scheduled retirement ages, whatever those happen to be. We can change our retirement ages and it'll domino through this whole thing. So we're actually in pretty good shape here. Now we get out here to age 63 and 62. And yeah, we can see that now we start to build up some debt again here. Our expenses, some of them were beyond inflationary, you'll recall, and that's going to hurt you with things like healthcare. And this wouldn't be unexpected that you get into your early 60s and healthcare expenses start to outpace other things. We did lose some income here. I can't remember who. I think Anne is retiring at this point as well. So we could say, hey, what if Anne continued working? So we see we have a deficit here already. And really, we just go to our data sheet, which I highlighted in red to make it obvious. And we say, what if Anne continues working until 65? And now we go back, and we should see that have a significant impact on our cash flow. Look at that. There we go. And you could go and figure out, you could look at a specific year of RRSP accumulation, for example, and you could say what happens to the RRSP based on retiring in those given years. There's all kinds of fanciness we can do here. So that gets us to the point where we are ready to start chipping away at those RRSP balances to help sustain us in retirement. We're going to do that in a separate video. So we'll end there. Hopefully you now have a multi-year cash flow sheet that builds out everything you need to get you up to the point of retirement. Thank you very much, and please do enjoy your continued studies.